The Labor Department reports that the U.S. added 206,000 jobs in June. The unemployment rate rose slightly to 4.1%. That's its highest point since November of 2021. But of course, all this comes amid high interest rates as the Federal Reserve tries to lower inflation. CBS News senior business and technology correspondent Jo Ling Kent joins me now to break down today's numbers and the implication for all of us. So, Jo Ling, let's start with today's numbers in mind. The labor market, it's so strong. It's continued to be persistently strong. But what does that actually mean for our viewers at home?
Well, taking a look at this number from the Labor Department, 206,000 jobs. If you were to describe it in 2 words, the labor market is softening and it's healthy at the same time. What we saw is jobs added in government, healthcare, construction, across the board, very much in line with economists' expectations, but certainly down from some of those hotter numbers we've seen earlier in the year. Now, I like to always look at wage growth. That's a really important one. It did cool off a little bit, which could be good news for interest rates and the Federal Reserve's decisions coming up this fall. And if you take a look at the reality of the situation, 3.9% wage growth year over year compared to last year, right? It still outpaces inflation just slightly. So that's good news when it comes to how much you're getting for your dollar versus how much you're earning in your hourly wage. But President Biden coming out with a statement from the White House this morning saying that there's still work to do, but he is pointing to the labor force participation rate and also saying that wages are continuing to grow faster than inflation. But the president also pointing out that there are still too many Americans who are feeling the squeeze economically, Lana.
Yeah, inflation has been so persistently sticky, as you well know. The Federal Reserve released its minutes this week from their June meeting, and we read there that the Fed is not ready to cut rates until it sees, quote, greater confidence that it's moving towards that 2% goal. You and I have discussed the possibility of a late summer, early fall rate cut. Does this now look like the Fed might hold steady through the end of the year?
Well, it depends on who you ask. Looking at the broader market, it looks like there's still a very good chance for a September interest rate cut by 1/4 point. You talk to Oxford Economics, they say that this jobs number, this wage growth, and this unemployment rate actually bolster the case for a September rate cut, which would be great news if you're trying to get into the housing market or just have the amount of, the cost of money get a little bit less expensive. But it's not guaranteed. And of course, we are going to be looking at the July Fed meeting coming up, looking at those notes coming out from Fed Chair Powell. And look, when I asked Fed Chair Powell last month about, what his message is to Americans, they just want us to continue to see meaningful movement down to that 2% inflation target. And good news is we're going to get some more information on that next Thursday when the consumer prices index comes out, and we'll get a better read on how prices are actually doing. They have been very sticky. You've probably felt that in terms of your rent, when it comes to the grocery store, all across the board. And there's also some monthly expenses that continue to go up. And we're talking about big ticket items, like auto insurance, for example, or maintaining the cost of owning a home. So these are all things that factor into what Fed Chair Powell and the FOMC are all thinking right now.
All right, Jo Ling Kent, always appreciate talking to you. Thanks.
Good to see you.